Let me tell you something that's going to sound wild. I lost a loan to Wells Fargo, and I'm actually glad I did. Because the way that deal went down, well, it's the perfect case study for why this channel exists. It's not about rate. It's not about who has the flashiest offer. It's about structure and the difference between a mortgage strategy that works for you and one that only works for the bank. So let's break this one down. I had a buyer, strong income, great credit. He was ready to buy a $2.5 million house. We were pre-approved, underwritten, ready to lock. I had him at 6.625 on a 30-year fixed clean deal. Then I got a call. Hey, Wells Fargo is offering me a 6% on a 7-year ARM. That's over 0.5% better than what you quoted me. Now, look, I'm not going to lie. That hurts because I know what goes into this. I've probably taken 15 late night calls, ran 7 different loan structures, worked this thing to the bone. But I also know something he didn't. When a bank gives you a rate that much lower, there's always a catch. Here's what they offered him. Wells Fargo says, sure, we'll give you 6%, but you got to move your entire down payment, $500,000, into a Wells Fargo account. Not just for a day, not just to show the underwriter, permanently. They want him to park his cash in their system. Why? Because while they're handing him that 6%, they're turning around and lending out his money at 18%, 24%, 29% through credit cards, personal loans, auto debt, the whole 9 yards. That's not a deal. That is a trade. He gives up liquidity, he gives up flexibility, all for the illusion of a better offer. They're using his money to underwrite their gain while marketing it like it's a favor. Now, here's the thing. I could have said, okay, I'll match that. Let's go toe-to-toe on rate. But I don't do that. I'm not trying to win the sticker price game. I'm here to win the structure game. So I offered him something smarter, a 3-2-1 buy down, fully funded by the seller. Here's what it looks like on a $2 million loan. Year 1, 3.625%, or $9,121 per month. Year 2, 4.625%, or $10,282 per month. And year 3, 5.625% at $11,513 per month. Year 4 and beyond, it comes back to 6.625 or $12,806 per month. Total savings in the first 3 years is over $32,000 compared to the starting full rate. And that's with no account lockups, no ARM adjustments, no hoops to jump through, just smart seller-funded strategy that puts real cash back in his pocket. And that's the point. Wells gave him a deal. I gave him a plan. With my structure, he's got options. He can refinance when rates drop, and trust me, they will. He's not tied to any one institution. He's not stuck in an ARM that might balloon in year 8. He's not trapped if he wants to buy another property, start a business, or move his own cash around. This is what the banks will never show you. Rate is easy. Flexibility is everything. And let me be clear, this wasn't even about math. This was about control, because when you let a bank dictate your structure, well, they own you. They get your deposits, they get your future business, they win on every side of the deal. And when you work with someone like me, you own your options. You get a real plan and you get a real deal. So did the client go with me? Nope. He still went with Wells Fargo. And look, I get it. That 6% really looks good on paper. The bank said all the right things. Big logo, shiny branch. It feels like a safe move. But let me tell you how this plays out. Year 7 rolls around. That ARM adjusts, his payment spikes. He wants to refinance, but he's stuck waiting on docs, approvals, more Wells Fargo policies. He needs cash, but his down payment is frozen inside their account. And that's when I'll get the call. I've been here before. This isn't theory, it's muscle memory. If you're a buyer right now or a realtor working with a client, you need to hear this. Stop chasing rate. Start demanding structure. Rate is only one variable. Structure is the entire plan. When you work with a real strategist, you're not just getting a number. You're getting exit ramps, seller leverage, lower upfront payments, faster equity, tax-smart timing, liquidity control, real negotiation. And that's how you win in this market. The banks aren't doing this. They can't. They're tied up by compliance, internal desks, deposit goals, internal overlays, all of it. You want to beat the banks? Stop playing by their rules. So yeah, I lost that deal, but I gained something a lot better. A perfect example of how the banks say that they're helping while quietly building a loan that helps them first. If you want a mortgage that's actually designed for you, if you want to stop being a number in a bank's quarterly earnings report, if you want to work with someone who builds strategy, not just quote rates, DM me the word strategy or leave a comment and tell me where you're stuck. I'll respond personally because that is what I do. This is Bank Beater and we're just getting started. Structure beats rate. Strategy beats sticker price. We build mortgages that work for you, not the bank. I'll see you in the next one.